Hey guys, welcome to my channel. In this video, I'm going to talk about Vaibhav Global, an Indian fashion retailer with global operations. I'll tell you all there is to know about the business and you'll see what makes it so interesting even at current stage. So let's begin with some history because that'll help us understand the transformation of the business over the years. Now, before we begin, I would like to point out this video is for educational purpose only. I'm personally invested here. So VGL was started in 1980 by Mr. Sunil Agarwal, who is still running the show. It went public in 1996, at which time it was primarily a wholesale B2B gem and jewelry exporter. Now, there are two key events that shaped the business. First is the global financial crisis. At that time, the company was manufacturing and selling jewelry through brick and mortar stores in the US. Also, it sold gem and jewelry to B2B customers like Walmart, JCPenney's, Macy's, and specialty jewelry stores. VGL had also started 24 hours online jewelry shopping channels in UK, US, and Germany. And due to the weakness in the economy, no one was interested in buying jewelry. This resulted in the company going into corporate debt restructuring. Subsequently, company did some restructuring. It exited Japan, closed its Thailand manufacturing, took an exit from the German market, closed its brick and mortar stores, and it lowered the selling price of jewelry because no one was interested in buying expensive jewelry. That's when it noticed that even during a recession, people have an appetite for value products. Plus, none of the other online retailers were addressing the discount jewelry market. So, with its direct sourcing capabilities and own manufacturing facility, it now had a winning formula. What further helped was that one of its main competitors, Gems TV, closed its US operations. Second key event was the period between 2014 and 2016. Now, due to intense competition from a company called Jewelry TV, VGL lost market share and hence was posting declining volumes. And this JTV was a company which until that point had lost a lot of market share to VGL. So it was trying to revive its growth using business promotion techniques like payment through installments, extended return period, and free delivery. At first, VGL thought that this was unsustainable, but it wasn't. Plus, there was a lot of employee churn around the same time. There was a lot of IT related expenses. Web volumes were impacted during the process of transition to the new desktop and mobile websites. So there were a lot of issues at that time. And customer experience was not optimum. All this resulted in earnings taking a serious hit. You'll see that when we discuss financials later. So, subsequently, VGL took various steps, including introduction of budget pay, which is the EMI services to customers. It allowed easy return of goods, launched a mobile app, and by FY17, it offered the same kind of services as its competitor, but at a lower average selling price. And all this made purchasing more convenient and affordable. Today, 36% of its sales are through the budget pay scheme, and it increased its focus on B2C while consciously scaling down B2B, which is just 1% of FY21 revenues. Now let's understand the business. Now let's try and understand VGL's value proposition. So who are Vaibhav's customers? What customer needs does it meet? So a typical customer is 40 plus women from an average income and above average income household. Now Vaibhav sells fashion jewelry, home, beauty, lifestyle, and more recently essential products. And it does all this at an average selling price which is 50% lower than its biggest competitor QVC, which sells everything under the sun. So its customers see VGL products as value for money, but it also provides company to a lot of women. See, a lot of these women, especially the 55 plus, are home alone all day, and this is a sort of entertainment for them. In terms of product mix, in FY16, the non-jewelry portion of the retail revenue stood at around 9%, and today it's at 31%. And this is good because non-jewelry is a lot bigger than jewelry. Now they have been continuously diversifying the portfolio. Recently, they added apparel and plan to manufacture accessories in the future. Now, all this is synergetic. The idea is that people will shop more at a place which provides more than just jewelry. Now, let's have a look at the various mediums via which Vaibhav sells its products. So Vaibhav has proprietary TV channels which include shows on all major cable, satellite and DTH platforms. And it also streams live through its website, YouTube and Facebook. And this is, as per the company, what they call TV revenues. Now all this is live 24 hours throughout the whole week. Now, coming to the web part, they have their own websites which host live streaming of what's on TV. Then they have fixed price catalog where you can buy what you want. Third component is online auction where items are put for bidding at $1 and the customer then competes against each other. Now, this inventory is usually the slow moving inventory from television. The benefit of this system is that it allows Vaibhav to launch 100 to 150 products a day without worrying about obsolete inventory. Web sales also include OTT platforms like Apple TV, Roku TV, etc. Marketplaces are Amazon, eBay, and social media platforms like Facebook and Instagram. Now, marketplace and social contribute just 3% to revenues, but both these channels have tremendous potential to grow and are growing at higher rate than the other platforms. In fact, the global social commerce market is expected to grow at a CAGR of 29% for the next 5 years. Now, web sales were at 19% of revenues in FY16 and last year it was at 36%. Now, as you can see here, web sales have grown much faster than television. Last year it further accelerated largely due to COVID. But it's important to not look at web and TV in isolation because they have a symbiotic relationship. A lot of times people watch something on TV and later buy the same item on the website. Now, an interesting point here is that the lifetime value of a customer who is omni-channel is approximately 15 times that of a web-only customer and about 8 times that of a TV-only customer. Why is that? Because TV is push marketing. So the TV host is trying to get the customer to buy something. And web is only pull. So a web customer is typically looking for a particular item. So if you combine the two, the value increases, and that's what VGL is trying to do. So they have their own channels in the US and UK, which also caters to Canada and Ireland. Now, as you can see, UK used to contribute 27% of revenues in FY16 and now it's at 32%. So UK has grown a lot faster than the US. And in the UK, they recently launched a new channel which is TJC Beauty, which focuses on beauty products. Now this runs just 4 hours a day currently, and more recently they launched Shop LC Germany. So Germany is Europe's largest home shopping market with 38 million TV homes. It's bigger than UK. So Shop LC Germany will also cater to Switzerland and Austria. Now Germany isn't new to them. They were there for a short period before the '08 financial crisis and they still have QVC Germany as the client. So first 2 years they will incur some operating losses and it should break even in year 3, but looks promising. Now VGL has compounded earnings at 46% over the last 5 years. Now what exactly is it doing that allows it to grow at such a rate in developed markets and that too in retail? The answer lies in its vertically integrated value chain. So it starts with product development, It has teams at both US and UK, and they have corresponding merchandising teams in China, India, Thailand, and Indonesia. Now, an interesting development here is that recently employees have been contributing to product innovation, and in such cases, a percentage of revenue is shared with the employees. So, based on trend research, customer suggestions, they use their own strong sourcing network of over 30 countries to source the products. Last year alone, they added 10 new countries. They have their own manufacturing facility in China and India. They manufacture own fashion jewelry, and very recently they started manufacturing textiles. Non-jewelry products are sourced from third parties. Now, all this has allowed it to be flexible, add 150 new products every day, and reduce time to market. A multi-country presence also helps in mitigating risk to supply chain. And during the pandemic, we have seen so many companies get into trouble due to disrupted supply chain. So, after manufacturing or outsourcing is done, they have to create content for the viewers because they have to tell a good story to the audience. Now, that matters when you're selling on TV because in this case, advertising is storytelling. Then they test the products with small batches, and if the product does well, they quickly accelerate that product velocity. And because of the robust supply chain, they can quickly do that. And if for some reason it doesn't work, then it goes to auction. Now, for any new entrant to replicate all this, it needs to have good relations with vendors to get products cheaper than VGL, and that's difficult without scale. It needs to invest in warehouses, negotiate with logistics companies for cheap and fast deliveries. It needs to buy airtime on US and British TV. It needs employees who understand sourcing, trend spotting, and marketing the product. And it needs to add new items every day to keep the customer engaged. So that is the competitive advantage. So now let's do a peer comparison with QVC, the largest player. And an interesting thing before we start is that VGL used to supply to QVC once. Now, when I say QVC, I mean QVC International, QVC USA, and the Home Shopping Network, which it acquired in 2017. Now, outside the US, QVC is present in Germany, Japan, Italy, and UK. Now, there are other competitors in the UK and US as well, but we are looking at QVC because that's the real competition. The others aren't doing so well. Now, the biggest difference between Vaibhav Global and QVC is the sheer size. Now, QVC has 90% of the market in US and UK. Last fiscal, it did $12 billion of revenue globally. And VGL, as you can see, is just about 3% of that now. Now, before we start comparing, please bear in mind that QVC is at a different stage of business life cycle. It's a mature company. So QVC's revenue per home in the US is about $60 versus Webhouse $3. So at $3 revenue per home, one could argue that Webhouse has a long runway. But bear in mind that the customers may not be the same. QVC, by its own admission, caters to above average and high income households, whereas Weber caters to average and above average income households. Moreover, QVC has a much more diversified portfolio. Jewelry is just 4% of QVC revenues, while for Weber, that's at 69% of its revenues. Lastly, customer retention is a lot higher, almost 90% for QVC and 51 for Weber. Now, if you have real competitive advantage, it means that compared to your rivals, you operate at a lower cost, command a premium price, or both. And we see that here. QVC's gross margins are at 35% versus 60% for Weber. That's because of Warehouse value chain, as we discussed earlier. It has its own manufacturing setup, direct sourcing offices, and Weber has its own brands. And this is where VGL is different from all its competitors. The only company which is manufacturing its own jewelry is the Jewelry Television. But because it's a private company, I don't have much data on it. Now, QVC sells third party brands and has very few in house brands. So, all this allows Vaibhav to have a much higher gross margin. QVC, by the way, is working on improving its sourcing, but because it's a big organization, these things take a lot of time. Now, last year, QVC also grew its revenues for the first time in 3 years, and it added a lot of new customers. So, COVID did benefit them. But also, Home Shopping Network, which they acquired in 2017, has finally turned around. So, it will be interesting to see if QVC continues this momentum and its effect on VGL's future growth. Now let's look at some of the key developments last year. Now, as you can see, e-commerce got a shot in the arm because of COVID. In 2020, the US e-commerce fashion industry accounted for 29% of total fashion sales, and VGL has made the most out of it. During COVID, when most companies were letting people go, VGL was hiring people. In fact, QVC fired about 400 plus people, and they have about 20,000 plus employees. And in December, VGL incorporated a new subsidiary called Vaibhav Lifestyle for manufacturing and export of garments. Now, fashion apparel is about 10 times the size of the fashion jewelry market in both US and UK. But there exists a gap in the availability of fashion for the people above the age of 40. There's no Zara or H&Ms for them. So VGL offers reasonably priced apparel catering to the taste and preferences of this age group. And this is doing extremely well. They started it with just 60 employees and they expect to ramp up to 500 employees by the end of the year. The next thing that they did this year was that they improved the shipping time. In UK, they now deliver to customers within 24 hours of ordering, and they hope to catch up with Amazon by the end of the year in the US. Now, if they can deliver as fast as Amazon in the US, this is huge because there's certain products where customers rather buy from Amazon just because it's faster, even though it might be expensive. Now, revenues have grown by 15% over the last 6 years. However, EBITDA has grown by 39%. That's because of operating leverage. VGL's business model is such that it involves a lot of high fixed cost of channel, employees, etc. Now, in good times, everyone talks about the benefits of operating leverage, but look at what happened between FY14 and FY16. Revenue degrew a bit, but EBITDA halved. And this is what happens when operating leverage works against you. Stock crashed by more than 70% over the next 2 years, and a lot of investors were not happy with the management's response to the whole situation. Now, a large part of this 15% revenue growth over FY16 to FY20 has been a combination of increasing average selling price and sales volume. So it's been a combination. So remember this point because we'll come back to it later. So here you can see the PAT versus free cash flow conversion. So mind that this is not operating cash flow, but it is free cash flow. So as you can see, it converts most of its net profits to free cash flow because there's hardly any capex. It's more of a OPEX heavy business and it's a cash rich company. Now, as you can see here, the gross margin has remained steady at about 60%. Management doesn't introduce any product unless it allows them to have a 60% margin. EBITDA has grown from 6 to 15% in the last 5 years, and the return on capital is very impressive. Now, the good thing about having a much higher ROCE than your competition is that if competitors lower prices, then you can lower it further and in turn hurt them. And knowing that discourages competition to get into price wars in the first place. Now, one of the concerns that people have around this business is cord cutting because people feel that eventually cable TV will die. Now, cable and satellite distribution is shrinking, yes, but there's a very interesting development that's happening here, and that's the increase in the number of OTA homes. OTA means over the air. Now, people capture that signal without paying the monthly cable fees. Most of the new televisions have built-in antenna, and people get HD broadcast for free. And OTA homes are increasing rapidly in the US from 13 million to 20 million homes in the last 7 years. Now, that increase is almost equivalent or slightly more than the loss of cable. Whatever they are losing on the cable, they are gaining on the OTA side. Now, besides that, they cater to an age group who remain pay TV subscribers. So, 81% of adults age 55 plus and 76% of those between 35 54 subscribe to pay TV. Now let's talk about the risks. Now the biggest risk is that this is retailing. It's very difficult to sustain a competitive advantage in retail. Even a company like Inditex, Zara, which is widely studied for its unique business model, has had periods of slow growth and then had to reinvent itself. Secondly, VGL's business model involves high fixed cost, which makes it vulnerable in bad times. Remember, operating leverage is a double-edged sword. Then there's risk of bad debts as budget pay orders increase. And lastly, degrowth of unique customers. Now, unique customer means any customer who has shopped in the last 12 months. It could be new or an old customer. Now, let's understand this point a bit better. So to understand the risk of degrowth, let us first understand Vaibhav's internal framework of growth. And this is what the company uses. Now, first is reach. So Vaibhav is currently present in 104 million households. Now, this has been around 100 plus minus 5 for the last 6 years. Now, I don't expect this to go up because QVC has a similar number. Now, new registrations on a TTM basis came at 3.4 versus 1.8 lakh in the same period the prior year. Now, just to let you know, these are FY21 numbers. So, customer registrations expanded very fast last year due to the pandemic. Now, customer retention rates stood at 51.5, and this was 50% the year before, and it was 48% 5 years. So you've seen a steady increase in that. Now, repeat orders were at 27 in FY16, and today again they're at 27, and this is the highest in the industry. So again, I don't expect this number to go up. Now, if any of the four R's that you see on the screen go up, then it has an impact on revenues. Now, unique customers have been 3.5 lakhs from FY16 to FY20. So, top line growth of 15% during the same period was largely driven by modest volume growth and ASP increasing. Right now, ASP is not going to increase much because it's already at 27 and Vaibhav wants to be an affordable player, right? So that's out of the equation. So volumes have to pick up, and for that, unique customers have to increase or repeat orders have to increase. Now, repeat orders, as we just saw earlier, is already best in the industry. So unique customers have to increase. Now, unique customers did increase last year by 38% and revenue grew by 28% last year. Now, the question is, how much of that was due to COVID? Now, Q1 numbers do look encouraging, but one will have to wait and watch. And that's the key risk here. So, final thoughts. Q1 was a good quarter. Revenues grew by 24% and EBITDA grew by 26%. And management has guided for 15 to 17% top line growth, meaning bottom line should compound at 20-25%, as there will be some losses due to German operations for the next 2 years, but after that it should contribute meaningfully. Now, what else will drive growth? Over the last 5 years, they have made a lot of investments in digital platforms, social DR, OTT, product innovation, team development. So company has taken a lot of small steps, and small steps don't get much attention from the investor community. But to have a competitive advantage in retailing is the everyday small steps that matter. So social media retailing is the new thing, and there's a lot happening in that space. Biggie is also stepping in. VGL has started working with micro influencers, but I would like to see them ramp up their efforts there. Next, apparels can be interesting because there's substantial demand for textiles from India due to anti-China sentiment. Textile companies, if you notice, have been posting very good results, and VGL could benefit here too. And in the future, at some stage, VGL will enter Japan, is what I feel, because they already sell in Japan. So there's a lot to look forward to. Now, valuations may look expensive if you just focus on PE, but this is a debt-free business with ROC of 60 and strong growth prospects. Plus, it's asset light and generates a lot of cash. Also, remember that all the investments in tech are operating expenses, but they will continue benefiting the company for years to come. So valuations will keep getting more expensive if it continues performing. So that was it. I hope this was useful. Thank you for watching, and please let me know if you have any questions.